Oh, boom! Back again. What's up, everyone? Dan Salonis here with Progress Realty Partners. And what say you? And I'm joined by my partner, Mr. Adam Dickert. Adam,
How you doing? Here we are live.
live and better than ever on this Wednesday, April 7th, from our broadcast studio here in Tinton Falls, New Jersey, aka our office. But this is what say you guys. We get questions every week from investors throughout the country asking us about commercial real estate, investing related topics. And we give our no nonsense, no filter answers right
No
here.
filter. No filter.
You might have to filter you a little bit.
Better have
So
cup.
we got 4 questions this week, guys. Count them. 2 for me, 2 for Adam. And I think the first one is actually going to be for me. I'm going to post this. Let's see. We got Chuck from Connecticut.
Boom. Put it up there.
Let's see here. Mr. Chuck wants to know,
Here
would
you
you
go.
rather,
Chuck.
huh?
Oh, you read it. You read it. You want me to read it?
Yeah, well, can you, I don't see nothing popping up, so.
I see it over here.
All
I don't
right,
know where
what
it
we
popped
got?
up. Chuck wants to know, would you rather a tenant pay more money with a shorter lease or pay less money with a longer lease?
Okay, so pay more money in rent for a short-term lease or less money for a long-term lease.
Correct.
Chuck, good question. I think it always depends on a case-by-case basis. And I say that because when you look at, what your game plan is for owning the property, if your plan is to own it long-term, then you want to secure your cash flow. I would always pick the tenant that's going to sign a longer-term lease, assuming they're a good tenant. It's not going to be something that goes out of business or anything. I would always rather a tenant that's going to sign a long-term lease and pay a little bit less in rent to secure that cash flow. But if it's a situation where you're buying a property, potentially a value add scenario where, it's only a 5-year hold for you or 7-year hold maybe, then you can go, the shorter term lease route and collect more income. So it always depends on the scenario. But again, assuming it's a long-term hold, for my money, secure the cash flow, get the long-term lease, take a couple bucks less a foot, and just don't worry about the space anymore. Basically.
Nailed it. You
Right?
nailed it.
Yeah. I think I
Some
nailed it.
some people on the flip side say, "Oh, more money up front," but again, what the game plan is obviously crucial to picking a strategy.
You know what too? Like tenants that want to sign short-term leases, like one of the things I always think about is why do you want a short-term lease? Like is it because you're not confident that it's going to work out, or you have you have subconscious doubts? Because if the tenant's doubting their ability to be successful, then as a landlord, what are you to think? So
Yeah, why the hell are you going to bet on them if they're doubting themselves? That's a good point.
our buddy Shane, what up, Shane? So yeah, it's always question why they want the short-term leases, liquidity issue, whatever the case. But I'm taking longer-term, less rent.
Real quick, I don't know if it's popped up for you. Shane's question popped up in Spanish for me.
No, did it?
I don't know if you put that in Spanish.
No, I just see Shane said, I'll take a storage facility in North Carolina with a side of Lidl supermarket. Oh, Mark, let's show Mark. I'm going to put you up there, Mark. Remember to do cost segregation on long-term holds. Good call, Mark.
Boom.
Mark's the man. Anybody who's watching, if you need a cost segregation analysis done, Mark and his company do great work. I know they're going to potentially help us out on a couple things we're doing. So reach out to Mark, connect with him, talk money, talk saving money, let him save you a bunch, let him go to work. Guy's a hustler. What's up, Mark?
All right, next question. Let's keep this
next
moving.
question. What we got here? Let's see, Adam. We got Chris from Connecticut. There we go. Would you rather redevelop a property, Adam, or build it new? And that's perfect ending because it rhymes with what say you.
Like Dr. Seuss over here. That is very situational. So let's take the current times we're in. COVID's kind of coming down on a downhill slope, and what people don't think about when you're building or even redevelopment is materials, right? Development ground up, there's, I would say for the most part, probably more juice in it in the long run, depending on your period of hold and what exactly it is. But along with those and hitting returns comes with budgeting. And I do not know how anybody can budget right now with the prices of steel and lumber and labor skyrocketing. We met with a guy yesterday for lunch, and he runs, industrial REIT. And he's like, in the last 6 months, the cost of steel literally went up 60%. So imagine you going through the approvals, getting permits, going through the town. You have a budget, great. This deal makes great sense on paper. In January, come May or July, you're like, holy crap, I'm 2 times over budget. So right now, I'd say redevelop. I think you probably have a little bit better chance of staying on budget. And also for me, if you guys watch our perfect retail property, we know the difference between a hammer and a saw. So redevelopment seems a little less headache ridden.
Yeah. By the way, the perfect retail property, just to remind everyone, I did win that competition. I was crowned victorious. By the way, just throwing that out there. But yeah, and you know what, Adam, too, to just build off your point on the price of steel and lumber going up. One of the things that this gentleman we met with yesterday too that he pointed out was, the length of time it takes for orders to come in right now. He was saying that if you put a steel order in today, you're probably not getting it until what, January?
Yeah, January. How do you know what? And also, that's if you buy it today, you pay for it today, the cost of it today, the labor might be more expensive, the other counterparts of construction. Unreal.
It's crazy. So it's a tough environment for developers right now. Right. The cost of everything's going up. The time of everything's getting pushed back. So it's just tough. It's a tough environment.
But to help mitigate some of that, our beloved partner Kathy, she commented over here. That's right. That's why you reach out to people like Kathy. They had people that help finance some of these construction, development costs, permanent financing, and literally everything in between. She was on a couple of weeks ago. I don't know if that's a money sign or a guy throwing up with how expensive everything is. What is that? What the hell is that?
Well, I tell you, and I'll say it until my face turns blue and I run out of oxygen. If you need any type of debt and you haven't spoken with Kathy, haven't spoken with someone from Progress Capital, I mean, there's no doubt in my mind you are losing money. You are leaving money on the table. So if you need debt, reach out to Kathy, reach out to Progress Capital. Best in the business.
What we got next?
Move forward. We got another question. Looks like it's Rishi from New Jersey. Let's see here. Adam, would you do me the honors?
Absolutely. A friend recently told Rishi about CrowdStreet. What should you look for when comparing the deals they have posted?
Okay. So CrowdStreet's a cool website. They've gotten really popular over the last couple of years. Anyone who doesn't know what CrowdStreet is, it's basically a platform for commercial real estate sponsors to post deals that they're raising equity for. So they have all different types of deals: multifamily, retail, industrial, development, the whole nine. So it's a good site. And then also Progress Realty Partners, prp.us, is a great site too. So check that one out. That's our website. But yeah, so to answer the question, what should you look out for when comparing deals? I was just talking with somebody about this on the phone the other day when I was discussing our single tenant Harley Davidson deal in Texas that we have out right now. And he was asking me about our underwriting and our exit cap rate. And he wanted to know why we underwrote for a higher exit cap rate than what we were buying it for. And it was almost like he was surprised, like there was some type of deeper reason behind why we show a higher exit cap rate. So when comparing deals, what I always look out for when looking at other people's deals is what is the exit cap rate? Because that's going to affect your IRR. It's going to affect your equity multiple. And it's easy, guys. It's so easy to make numbers do what you like, paint the picture that you want to be painted. So a lot of guys, they'll buy a property, 6 cap, 4 cap, whatever it is, and you look at the exit cap rate, and it's even lower than what they bought it for. And I just, from a conservative standpoint, I don't understand how groups could project a lower cap rate than what they're buying it at, unless it's an extreme value add situation. But even in that scenario, if you want to know if your deal makes sense, you choose the same cap rate or go higher, because if the numbers still look good at a conservative exit cap rate that's higher than your purchase, then that can show you that it's a good deal. But if your numbers only look good when you have a lower exit cap rate than what you bought it for, then you're just making the numbers say what you want. So I get like real fired up about this subject because I just don't I don't know, like everybody just wants to paint the rosiest of pictures. Nothing bad's ever going to happen. Cap rate on the property they're buying is only going to get lower. It's only going to get more expensive when they sell it. But I mean, damn, like at the end of the day, nobody, we all have our projections. We all have our thoughts of where things are going. But like it's lip service, man. It's marketing, and it's just
So
marketing in such like a just frustrating way from my perspective. That would be what I look out for. Rishi, sorry for the rant, but look at the exit cap rate, because that's that's going to change all the numbers. It's going to make everything look rosy, and it's going to give you an indication of how conservative. Because everyone likes to say they're conservative in their underwriting. Oh, we're so conservative. But that's going to give you really the great picture there of how conservative they are. The exit cap rate, and if that number is significantly lower than what they're buying it for, that would be a red flag for me immediately. But that's just me.
Reese, if you're looking at CrowdStreet, you probably have knowledge of other groups out there. Not going to mention the guy's name, but some guy out there goes out there and buys 500 brand new developed Class A units, multifamily, buys at a 4.5 cap. You look at his projections, and they're selling at 3.75 cap in a couple of years. You probably know who I'm talking about. May or may not have been a lawsuit on him recently, but stuff like that, it just doesn't make sense. So exit cap rate is a great initial indicator.
Does his name rhyme with Srant Bardone?
Yeah, it does.
Yeah, just man, be careful, guys. There's all kind of groups. Just be careful. All right, let's move on. We got Angie from Delaware, Adam.
Meantime, Glenn Hart, yes, we know you're from Texas. Yes, CrowdStreet just moved down there like 10,000 other companies.
That's right. Glenn, you're our boy. When we go back out to Texas, we got to get together. We appreciate you. So, Angie from Delaware, Adam, how else can you evaluate a property besides the cap rate? What say you, Adam?
Say me. There are a number of different metrics, right? Return, depending on what you're looking for. You're looking for a hold period. You're looking for a value add deal, stabilized deal. I mean, you can cap rate, cash on cash. You can use IRR, equity multiple. There's a million different ways you can skin a cat, right? But the most immediate, you get a brand new OM. You're evaluating a deal. Let's say like the asset class and the general area you're buying in. I would say price per foot is probably the most immediate go-to outside of cap rate. Right? Everyone knows cap rate, right? NOI divided by your purchase price, great, the most basic metric. Price per foot will also tell you pound per pound how you hold up in that market, in that asset realm, in the area where the asset compares. If you're getting a retail center for $45 a foot, right? Either it's a big value add deal, either everything in the market is dilapidated, either there could be a number of different things. If you're buying the same shopping center for $800 a foot, you're like, holy shit, let's take a step back, right? Evaluate, look at the comps in the area, price per foot, cap rate, and then if you're going to leverage something, maybe cash on cash will be the next immediate. But price per foot is one of our first go-tos, gives you a very healthy understanding of what you're buying, pound for pound.
Yeah, agreed. And I think this is what you were getting at too. When you're buying at a low price per foot relative to another property in the market that a developer would develop, and maybe it's going to cost him $150 to $200 a foot all in to develop a property. The rents that they have to charge at that type of property to be profitable are going to be much higher than what you're going to have to charge at your property, because you're buying it at a lower price per square foot. So from a competitive standpoint, it's always good to buy at a low price of replacement cost, because that gives you a competitive edge in the market to be able to still be profitable, still make a good return at a lower rent number than what some of the other properties would have to charge. And I think that's an important component too. But
yeah, you're all in redevelopment costs, soft costs, hard costs, labor, materials, everything.
Right. And like we were just saying, the cost of materials, steel, lumber, everything's going up. And that's so listen, it all right. Shit runs downhill. That all trickles down. Development costs are going to be higher. That means rent costs are going to be higher. No one goes unaffected when something like this happens. So if you could buy at a low replacement cost, you set yourself up to be able to charge lower rents and be able to compete with better tenants and ultimately get better property. So good point, Adam. Awesome job today, bro. I like that quarter zip you got on. That red looks good with you.
Yeah, it really makes my eyes pop, right? So my mom said.
It makes your eyes pop. Anyway, guys, that was this week's What Say You with Progress Realty Partners. And just as a reminder, anyone who is interested in direct ownership, commercial real estate investment opportunities that offer dependable cash flow while you get to hang out on the beach, go golfing, hang out with the wife, don't hang out with the wife. We don't really care what you do with all the spare time you'll have. But if you're interested in things like that, check out our website, prp.us. We do have a deal right now that's sick, I like to think.
That's an understatement.
Understatement for sure, but offers great returns, awesome stability. It's in one of the best markets in the country, Dallas, Fort Worth, Texas. So if you're interested in checking that out, shoot Adam or I a message or visit our website, prp.us. But that was this week's What Say You? I'm Dan Salonis.
I'm Adam Dickert.
We'll catch you guys next week when we got another 4 questions and a couple more answers. Until then, sayonara.
Adios.